Welcome back to the channel. Today we are diving deep into one of the most influential books ever written about personal investing. The book is called The Little Book of Common Sense Investing by John C. Bogle. This is not just another finance book that sits on your shelf gathering dust. This is a book that literally changed the way millions of everyday people think about money, markets, and their financial futures. I want to take you on a thorough journey through every major idea in this book. Its incredible history, why people love it, and what each chapter actually teaches us. Let us begin. To understand why this book matters so much, we need to first understand who John C. Bogle actually was. He was not a hedge fund manager chasing quick profits. He was not a Wall Street trader who made billions in a single day. He was something far more radical for the financial industry. He was a man who believed that regular everyday people deserved a fair shot at building wealth. He founded the Vanguard Group in 1974, and he did something that no one else in the history of mutual funds had ever attempted. He created the first index fund available to individual investors. Before that moment, index funds existed only for institutional investors like pension funds and universities. Bogle looked at the data, looked at the fees, looked at the overwhelming evidence that most professional fund managers could not consistently beat the market, and he made a decision that would shake the entire financial industry to its core. The writing background of this book is fascinating. Bogle spent his entire career fighting against the high fees, the hidden costs, and the self-serving practices of the traditional mutual fund industry. He watched as investors poured trillions of dollars into actively managed funds that, year after year, underperformed simple market indexes. He saw advisors recommending complex products that generated massive commissions for themselves while delivering mediocre returns for their clients. He saw people making emotional decisions during market crashes, buying high out of greed and selling low out of fear. The Little Book of Common Sense Investing was his attempt to distill decades of experience into a single, clear, accessible guide that any ordinary person could understand and follow. He wrote it not as an academic exercise, but as a genuine mission to empower everyday investors. The core philosophy of the book can be summarized in one powerful idea, and that idea is simplicity. Bogle argues that the most reliable path to building long-term wealth is not through stock picking, market timing, or chasing hot investment trends. The most reliable path is to own the entire market through low-cost index funds and to hold them for decades. He compares the investment process to a massive economic football game where professional fund managers are the players and individual investors are the spectators. The players take all the effort, all the risk, and all the rewards, while the spectators get whatever is left after the players have taken their cut. Bogle's central argument is that the spectators should simply become owners themselves instead of paying professional players to manage money on their behalf. One of the most powerful concepts Bogle introduces is the role of costs in investment returns. He demonstrates through clear mathematical examples that even small differences in fees can have enormous long-term consequences. Let me paint a vivid picture for you. Imagine two investors who both earn a 10% annual return from the stock market. Investor A pays a 1% annual fee. Investor B pays a 2% annual fee. That 1% difference might seem tiny. It might seem like something you would not even notice in your daily life, but over 30 years, that 1% gap can consume tens of thousands of dollars from your portfolio. Bogle calls this the cost matters law, and he proves it with undeniable mathematical precision. Every dollar you pay in fees is a dollar that cannot compound for you. Every dollar saved in fees is a dollar that works for you instead of working for the financial industry. Bogle also introduces what he calls the Great Divergence, which is one of the most important charts in all of investing literature. He shows how the gap between what the market earned and what investors actually earned has been growing wider and wider over the decades. The market itself continued to climb, delivering solid returns to anyone who simply held a broad index fund, but the average individual investor, chasing performance, paying high fees, trading constantly, and making emotional decisions, consistently earned far less than the market itself. This divergence is not a mystery. It is a direct result of behavioral mistakes and excessive costs. When you remove those two factors, you no longer need to be a genius to build wealth, you simply need to be patient and sensible. Let us now walk through the key chapters of the book and explore what each one teaches us. The first major section establishes the fundamental principles of investing. Bogle opens by explaining the difference between being an investor and being a speculator. An investor earns money because companies grow, because businesses become more profitable, and because the economy expands over time. A speculator tries to profit from price movements, from predicting what someone else will pay for an asset tomorrow. Bogle makes it absolutely clear that the stock market exists to reward investors, not speculators. When you buy shares of a company, you are buying a piece of a real business that produces real goods and services. Your returns come from the underlying growth of those businesses, not from guessing whether someone else will pay more for your shares next week. The chapter on the power of compounding is where Bogle truly shines as a teacher. He explains compounding not with dry mathematical formulas, but with relatable stories and practical examples. He describes how a small amount of money invested consistently over a long period can grow into a life-changing sum. He emphasizes that time is your greatest asset when investing. The longer you stay invested, the more powerful compounding becomes. He uses the analogy of planting a tree. If you plant a tree today and nurture it for 30 years, it will grow into something magnificent. If you wait 20 years to plant the tree, you will spend the next 10 years watching it catch up, and you will never reach the same height you would have achieved by starting earlier. Investing is exactly the same. The best time to start was decades ago, the second best time is today. Bogle dedicates an entire chapter to explaining index funds, and he does so with remarkable clarity. An index fund is simply a fund that buys every stock in a particular market index, like the S&P 500. It does not try to pick winners, it does not try to time the market, it simply buys everything and owns a tiny piece of every publicly traded company. This approach might sound boring to some people, and Bogle would agree with you. He says that investing should not be thrilling, it should be sensible. He argues that the boring approach is almost always the winning approach because it eliminates the biggest enemies of investment returns, which are fees, taxes, and emotional mistakes. When you own an index fund, you automatically diversify across hundreds or thousands of companies. You eliminate the risk of any single company going bankrupt and wiping out your portfolio. You eliminate the need to read financial statements or analyze balance sheets. You simply own the entire market. The chapter on the folly of market timing is one of the most important in the book. Bogle presents overwhelming evidence that even professional investors consistently fail at trying to predict whether the market will go up or down. He shares stories of famous investors and fund managers who made bold predictions about market crashes and rallies, only to be wrong time and time again. He explains that missing just a few of the best days in the market can dramatically reduce your returns. If you stayed invested in the S&P 500 from 1990 to 2020, your returns were outstanding, but if you missed just the 10 best days during that period, your returns dropped by nearly half. The problem is that the best days in the market often occur during the most dramatic crashes, when everyone is terrified and everyone wants to sell. If you try to avoid losses by selling during downturns, you will almost certainly miss the recovery, and you will permanently damage your portfolio. Bogle devotes significant attention to the behavior of fund managers and the true cost of active management. He reveals that the vast majority of actively managed funds fail to beat their benchmark indexes over long time periods. He does not attack fund managers personally. He argues that the structure of active management makes outperformance extremely difficult. When you pay a manager to pick stocks, you are asking them to beat the market, but every time they sell a stock, someone else buys it. The market is a zero-sum game before costs, and after costs it becomes a negative-sum game for active investors as a group. The fees, the trading costs, the bid-ask spreads, and the tax consequences all work against the active investor. Bogle calculates that the typical active fund investor loses between 1 and 2% of their returns every single year to these costs, and that gap compounds relentlessly over decades. The chapter on asset allocation is another critical section. Bogle explains that your mix of stocks, bonds, and other assets should be determined by your age, your risk tolerance, and your time horizon. He recommends that younger investors hold a higher percentage of stocks because they have many years for their portfolios to recover from downturns. He suggests that older investors gradually shift toward bonds because they need more stability and have less time to recover from losses. He provides a simple formula for determining your bond allocation, which is to subtract your age from 100, and that number represents the percentage of your portfolio that should be in bonds. So if you are 30 years old, you would hold 70% in stocks and 30% in bonds. If you are 60 years old, you would hold 40% in stocks and 60% in bonds. This is not a rigid rule, but it is a sensible starting point that keeps your portfolio balanced with your life circumstances. Bogle also addresses the emotional side of investing, which he considers perhaps the most important factor of all. He acknowledges that markets will crash. He acknowledges that there will be periods of extreme fear and panic. He tells the story of how he personally felt during the market crashes of his career, and how he resisted the urge to sell. He emphasizes that the single most important investment decision you will ever make is not which fund to buy or when to buy it. The single most important decision is what you do when the market drops by 20, 30, or 40%. Will you panic and sell, or will you stay the course and continue buying? Bogle argues that every major market crash in history has been followed by a recovery and new highs. The only way to lose money during a crash is to sell your investments at the worst possible time. One of the most powerful chapters deals with the concept of the investor as owner. Bogle constantly reminds his readers that when you buy a stock, you are not buying a ticker symbol on a screen. You are becoming a partial owner of a real business. You own a piece of companies that produce food, that build cars, that create software, that provide healthcare, that deliver packages to your doorstep. These companies employ real people, they pay real taxes, and they generate real profits. When you own index funds, you own tiny pieces of all of these companies. You benefit from the productivity and innovation of the entire American economy. Bogle frames investing as a patriotic act, a way to participate in the economic growth of your country and to share in the prosperity that hardworking people create every single day. The book also contains practical guidance on how to actually implement a low-cost index fund strategy. Bogle walks readers through the steps of opening a brokerage account, selecting appropriate index funds, setting up automatic contributions, and rebalancing your portfolio periodically. He advises readers to avoid funds with expense ratios above 0.5%. He recommends broad market index funds for stocks, total bond market index funds for bonds, and international index funds for global diversification. He emphasizes the importance of automating your investments so that you buy consistently every month regardless of what the market is doing. This automation removes emotion from the equation and ensures that you are always building your wealth systematically. Bogle dedicates a chapter to the tax advantages of index funds compared to actively managed funds. He explains that active funds generate massive trading activity, which creates capital gains distributions that are taxable events for investors. Index funds, by contrast, rarely trade because they simply hold whatever is in the index. This means they generate far fewer taxable events, which allows your money to grow more efficiently inside tax-advantaged accounts like IRAs and 401k plans. Bogle points out that taxes are another hidden cost that erodes investment returns over time, and that index funds are structurally designed to minimize this particular cost. The section on retirement planning is particularly relevant for everyday readers. Bogle explains how index fund investing fits into a complete retirement strategy. He shows that even modest monthly contributions, when invested in low-cost index funds over a 30 or 40-year period, can grow into substantial retirement nest eggs. He provides concrete examples showing that a person who contributes just $200 a month to an index fund from age 25 to age 65 could accumulate over $1 million, assuming historical market returns. This is not a guarantee, but it is a powerful illustration of what consistent, sensible investing can achieve. He urges readers to start early, to contribute as much as they can afford, and to never stop investing regardless of market conditions. Bogle also tackles the subject of financial advisors and the conflicts of interest that exist in the industry. He warns readers that many financial advisors are paid commissions on the products they sell, which creates a fundamental conflict between what is best for the client and what is most profitable for the advisor. He recommends that investors either find fee-only advisors who charge a transparent hourly or flat fee, or simply invest on their own using low-cost index funds. He argues that the best financial advice is often the simplest advice, and that the complexity sold by many advisors is often a vehicle for extracting fees rather than a genuine source of value. The reviews and praise for this book are overwhelmingly positive. Readers consistently describe it as the most important investing book they have ever read. Financial professionals call it a masterpiece of clarity and common sense. Regular people who had no interest in finance before reading it report that the book gave them the confidence to start investing and the knowledge to do it correctly. Critics praise Bogle for his honesty, his humility, and his genuine commitment to helping ordinary people rather than enriching himself. Many reviewers note that the book is short, accessible, and free of the jargon and complexity that characterizes so much financial literature. It has been described as a gift to every investor who wants to build wealth without needing a finance degree. What makes this book truly special is that it is not just theoretical. Bogle lived his philosophy every single day of his career. He managed billions of dollars using the exact strategies he recommends in the book. He did not write about index funds from an academic distance. He built the entire Vanguard empire around them. He gave back millions of dollars of his own compensation to shareholders because he believed that investors should not have to pay for his excessive lifestyle. He faced enormous pressure from the financial industry, which had every incentive to discredit him and his ideas. He faced internal opposition from colleagues who wanted to launch complex products that generated higher fees. He stood firm, and he won. The success of Vanguard and the explosion of index fund investing worldwide are living testaments to the power of his ideas. Bogle also addresses the psychological trap of performance chasing, which he identifies as one of the most destructive behaviors in investing. He explains that when a particular fund has a great year, investors flock to it, driving up its size and often pushing its future returns lower. By the time most investors buy into a hot fund, the best returns are usually behind it. Bogle calls this the yo-yo effect, where money flows into funds after they have performed well and flows out after they have performed poorly. This behavior guarantees that investors will buy high and sell low, which is the exact opposite of what they should be doing. He urges readers to resist the temptation to chase performance and to stay committed to their simple, boring, low-cost strategy regardless of what the headlines are saying. The chapter on the role of dividends is another important section. Bogle explains that dividends are a real source of return, not just a nice bonus. He shows that over long periods, a significant portion of total stock market returns comes from dividends, especially when those dividends are automatically reinvested. He describes how dividend reinvestment allows you to buy more shares at lower average prices during market downturns, which further accelerates the power of compounding. He reassures readers that they do not need to chase high dividend yields or try to pick dividend stocks. The broad market index fund automatically includes dividend-paying companies and handles the reinvestment process for you. Bogle dedicates considerable attention to the difference between nominal returns and real returns. He reminds readers that inflation is a silent thief that erodes purchasing power over time. A 10% nominal return might sound impressive, but if inflation is running at 3%, your real return is only 7% over decades. Inflation can dramatically reduce the value of your savings if you are not careful. He recommends that investors think in real terms, focusing on returns that outpace inflation rather than simply looking at headline numbers. This mindset shift is subtle but incredibly important for long-term financial planning. The book also contains a powerful chapter on the importance of staying invested during market bubbles and crashes. Bogle shares his personal experience during the dot-com bubble of the late 90s. When technology stocks were soaring to absurd valuations, he describes the immense pressure he felt from clients and colleagues to abandon his index fund strategy and chase the hot technology stocks of the era. He resisted that pressure, and he was proven right when the bubble burst and most Technology stocks collapsed. He also discusses the 2008 financial crisis, when fear was so widespread that even sophisticated investors panicked and sold. Bogle urged his investors to stay the course, and history proved that his calm, rational approach was the correct one. One of the most memorable passages in the book is Bogle's discussion of the difference between price and value. He explains that the price you pay for an investment has a profound impact on your returns, regardless of the quality of the underlying asset. He uses the analogy of buying a house. If you buy a wonderful house at an inflated price, you might still lose money. If you buy a modest house at a fair price, you are much more likely to profit. The same principle applies to stocks and funds. A high-priced fund with high fees will almost certainly underperform a low-priced fund with low fees, even if the high-priced fund has slightly better stocks. Price matters more than you think. Bogle's writing style is one of the reasons the book is so beloved. He writes like a wise grandfather who genuinely cares about your well-being. He never condescends to his readers. He never uses complicated language to sound smart. He explains complex ideas in plain English that anyone can understand. He acknowledges the fears and doubts that investors naturally feel, and he addresses them with patience and compassion. He writes with conviction but never with arrogance. He knows he is right, but he also knows that he is not always right and that investors should think for themselves. The book also contains a surprisingly moving chapter on the moral dimension of investing. Bogle argues that how you invest says something about who you are as a person. He believes that investing should be done with integrity, with patience, and with a genuine concern for the long term. He criticizes the culture of greed and short-term thinking that dominates Wall Street. He calls for a return to values like honesty, fairness, and responsibility in the investment industry. He sees index fund investing not just as a smart financial strategy, but as a moral choice that benefits both the individual investor and society as a whole. Bogle addresses the question of whether index fund investing is too simple to work. He anticipates the skepticism that many people feel when they hear that the best strategy is also the simplest strategy. He responds by pointing out that many of the most effective things in life are simple: eating well, exercising regularly, saving money, maintaining strong relationships, getting enough sleep, avoiding debt. These are all simple concepts, but they require discipline and consistency to implement. Effectively, investing is the same. The strategy is simple, but it requires the discipline to stick with it through good times and bad times. That is why most people fail at it, not because the strategy is complicated, but because it is psychologically difficult. The section on international investing is another valuable part of the book. Bogle acknowledges that the United States has been the best performing market in recent decades, but he warns readers not to assume that this pattern will continue forever. He recommends that investors include some international exposure in their portfolios to benefit from growth in other parts of the world. He suggests that a simple international index fund can provide this diversification without adding significant complexity or cost. He cautions against trying to pick individual international stocks or timing international market movements, arguing that these activities add cost and risk without adding meaningful expected returns. Bogle's discussion of behavioral finance is remarkably prescient. Long before behavioral finance became a mainstream field of study, Bogle was writing about how human psychology undermines investment returns. He identifies specific cognitive biases that cause investors to make mistakes, such as recency bias, where people assume that recent trends will continue forever. He identifies confirmation bias, where investors seek out information that confirms their existing beliefs. He identifies loss aversion, where the pain of losing money is psychologically twice as powerful as the pleasure of gaining the same amount. By naming these biases and explaining how they affect behavior, Bogle helps readers become aware of their own psychological traps and avoid falling into them. The book also contains practical advice on how to handle market volatility. Bogle acknowledges that stock prices will fluctuate. He acknowledges that there will be years when your portfolio drops significantly. He advises readers to view market declines as opportunities rather than threats. When prices are low, your regular monthly contributions buy more shares at lower prices. This is exactly what you want to happen if you are a long-term investor. He tells the story of how his own Vanguard funds performed during the worst market crashes, and how investors who stayed invested were rewarded with strong recoveries. The message is clear and consistent. Volatility is the price of admission for long-term market returns. You do not need to avoid it, you need to embrace it as part of the process. Bogle's final chapters bring everything together into a practical action plan. He summarizes the key principles, reiterates the importance of low costs, diversification, and long-term commitment, and provides a step-by-step guide for implementing his strategy. He encourages readers to write down their investment plan, to review it periodically, and to resist the urge to make changes based on short-term market movements. He reminds readers that investing is a marathon, not a sprint, and that the investors who win are not the smartest or the most talented, but the ones who stay the most consistent and the most disciplined over the longest period of time. What makes the little book of common sense investing truly timeless is that it speaks to something universal about human nature: the desire for quick riches, the fear of missing out, the panic during downturns, the overconfidence during bull markets. These emotions do not change from decade to decade. They are hardwired into human psychology. Bogle understood this deeply, and he wrote his book not just to teach people about index funds, but to help them understand themselves. He knew that the Biggest obstacle to investment success is not a lack of knowledge, it is a lack of emotional control. By combining sound financial principles with deep psychological insight, he created a book that is as much about personal growth as it is about financial growth. The impact of this book extends far beyond its pages. It has influenced millions of investors around the world to adopt simpler, cheaper, more effective investment strategies. It has contributed to the massive shift away from actively managed funds toward index funds and ETFs. It has inspired a new generation of financial advisors to put their clients' interests first rather than their own commissions. It has become a required reading in many business schools and investment courses, and perhaps most importantly, it has given ordinary people the confidence and the tools to take control of their financial futures instead of handing their money over to expensive professionals who rarely deliver on their promises. As we close out this deep dive, I want to leave you with one final thought. John C. Bogle spent his entire career fighting for the little guy, the everyday investor who works hard, saves what they can, and deserves a fair chance at building a secure future. He proved that you do not need to be a genius, a Wall Street insider, or a financial expert to build lasting wealth. You simply need to follow a few simple principles. Keep your costs low, stay invested for the long term, and resist the emotional traps that catch so many other people. That is the true legacy of the Little Book of Common Sense Investing. It is a book that empowers you, that respects your intelligence, and that gives you a clear path forward in a world that often seems designed to confuse and exploit you. Thank you for spending this time with me, and I hope you take these lessons to heart.